Hey, what's going on, everybody? Derek here. What I want to talk about today is when having term insurance backfires. You know, some entertainers and organizations, they preach buy term and invest the difference. But is this really a sound strategy? The concept behind buy term and invest the difference is this. You get insurance cheap and you invest the difference, so when you get to retirement age, you'll have enough savings available where you can essentially self-insure. The reality, though, much different. Did you know that according to Transamerica, the median saving for 60-something-year-olds is $172,000? Does this sound like people saved enough to self-insure? No, it sounds like they got about 3 to 5 years worth of living expenses. To me, this sounds more like buy term and spend the difference. Let me give you a scenario. I recently inherited an account. Looked up the information. They wanted to know what their options were. They took out a policy that went active on October 25th, 2010. It was a 10-year level term. What that means is the death benefit doesn't change and the premiums don't change for the 10 years. By the way, he was 69 years old when this happened. Now, when that 10-year period runs out, the insurance company reserves the right, and they will, increase the premiums every year. It's called annual renewable term. This is why they were panicking. His term is about to expire, 10/25/2020. Okay? So now, from 10/25/2010 through 10/25/2020, he was paying $123.35 a month. Now, let's pull this up on the screen. Now, if you look at it, in year 11, his premiums can be as high as $12,131.16. Okay, that's $1,000 and $1,010 a month. Though they did say the actual premiums were going to be $506. So he said he's probably going to keep this policy one more year. Okay, the $12,131.16 is the absolute most the carrier can charge. He did also say, I probably can't afford much beyond that. If you look at it, look at year 13, look at year 15, look at year 16 when he's 85. The premiums can be as high as $22,000 and change a year. This makes it prohibitively expensive. I say shame on the agent who actually sold his policy to them. Back to me. A lot of people in this business, they could call themselves insurance agents or financial advisors, whatever they want. They want to make the sale. So they're willing to, show the least expensive policy for that moment. As you can see over the long term, it clearly isn't the least expensive, even though we're led to believe that term is the least expensive. It's the least expensive initially, but as you can clearly see, it doesn't stay that way. They make the sale, they're happy, they get their commission, but they are not thinking about this poor couple 10 years down the road, 15 years down the road. And this is why it's so important that we understand the person and the people involved. And don't just try to make the sale, okay? That's my rant for the day. Anyway, so let's go back to this. So basically at the end of 10 years, he's going to spend $14,802. Now, if he goes for another year at the 506 and doesn't pass away, that's over $20,000 down the tubes, because he said he can't afford it beyond that. So this policy is likely to just vanish. He'll have no death benefit. He may or may not qualify for something else at this point. Now, on the flip side, he could have done something very different at 69 if the insurance agent either had the knowledge or cared. They may not have had the knowledge, but again, shame on that agent if they don't know what they're doing, right? So with that said, at 69 years old, he had choices. He qualified for something. He could have qualified for this. Let me pull this up on the screen. He could have done $500 a year, $500 a month rather, $6,000 a year for 12 years. So that's a $72,000 investment. He'd have a $100,000 death benefit. And then as you can clearly see, he doesn't have to put another penny into this. And he's guaranteed to have $100,000 until he passes away. Now, if he lives to 103, 104 years old, you could see there he may have to put some more premiums on it. But guess what? If I was that person, I'd be willing to take that chance. According to life expectancies, he's going to have the 100,000 until he passes away. That's my point. Term isn't always the right thing. I'm not anti-term. I believe in term. But you got to understand people's situations. Death benefit was very important to these people. What made that agent think in 10 years it wouldn't be? If it's important to somebody at age 69, it's going to be important to them at age 80, believe me. They're not making more money, they're making less. They're retired or close to it. So it's so important. By the way, if you want to get a real financial education, sign up today for my course, Financial Foundation University. It is absolutely free for lifetime access. I will not ever charge you to be a part of that university. Just use coupon code FFU100. Also, I have locked arms with a company called MWR Financial. This company helps you improve your credit, eliminate debt. I do all that too, and it's in my university, but I can't reach the amount of people. So if you want to hire professionals to help you eliminate debt, improve credit, change your W-4 so you can have more take-home without risk of owing money, I'm going to put a link in the bio, down in the comments so you can see that as well. Okay, these are professionals. You'll work with CPAs and tax attorneys, and it's a low membership cost. So that can help you get your finances in order real quick. But listen, if anything, just sign up for the university. It's not going to cost you anything. Hey, do me a favor. Like this video. Give me a comment if you have any suggestions or thoughts or anything you want me to discuss in future videos. And please share this out. We got to get this out to the world. I look forward to chatting with you. Hope you found value in this, and you have yourself a fantastic day. So long.